Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsarthi. And many investors, financial advisors, and market participants keep asking me whether interest rates have peaked out. Is it time to invest in long duration bonds or long term bonds? Or should they invest in bonds that are over 3 years of maturity? Or should they still worry about interest rates going up further and stay in the 1 to 3 year maturity investments? For fixed income investors have not had it very easy over the last couple of years. Interest rates have come down very sharply because of COVID, and then the inflation has gone up very sharply. And fixed income investors have been earning very low returns over the last couple of 2 3 years, and this is really hurting them because with volatility in equity markets, the fixed income is a stable investment, and but it has to generate enough returns so that it compensates for inflation and also takes care of their portfolio returns needs. And bonds have been very volatile. And if you really look at it, if you see the performance of government bonds, they have lost a lot in value and prices in the last couple of years. So have been highly rated corporate bonds, and even in ETFs like Bharat bond ETFs, they have seen NAVs falling very sharply. At these levels, many investors keep thinking that should or financial advisors keep wondering whether that at these levels, because they have been earning so less in the last couple of years at such higher levels, it maybe makes sense to start locking on to yields. But the question is, uh, why why do you or why does anyone think that interest rates are close to peaking out? That is all the worst is over for the markets. Now, just because the interest rates have gone up and uh, the yields have gone up in bonds, now let's just take you through what are all the yields available in the market now. So you have government bond yields. 3 year government bond yield is at 730, 5 year at around 745, 10 year around the same levels. State development loan yields are around 785. PSU bonds, again, 2 to 10 year bonds are in a range of 720 to 785, 8%. Um, then you have Bharat bond ETF, where 3 year yields have come up to over 7.5 levels, around 760. And the 10 year is closer to 785. So these yields have gone up substantially. They were all well below 6.5% uh, in the last 1 year. And this has really, those investors who have actually locked on to yields at 6.5% are earning much less than what is available now. And but the main part is they can't sell their investments because they'll make huge capital loss. Just to give you how much capital loss they'll make in a 10-year Bharat bond ETF, if they sell now, they will make about 6 to 7% of capital loss. And that will take away all the returns that they have been earning. Hence, it puts everyone in a difficult spot um, because there is worry. Previous investments have not made any money. And current investments, because previous investments have not made any money, the current investments, there is real reluctance to invest. And so this is the big issue facing the investor community. And as we have been at INR bonds, at least I have been very vocal in saying that interest rates are going to go up. The biggest risk in the market is government bonds, and this is globally as well. And purely because of the fact that central banks are printing money, keeping rates at ultra record lows, and the governments are borrowing heavily. Now, all this is a death trap for long-term bonds, government bonds, and that is what has happened. So we have seen the carnage in Europe. The UK gilts have lost about 70%. Most of the European bonds have lost so much. US Treasury yields have gone up very sharply. There is huge amount of losses. In UK, pension funds are facing huge amount of risk that is that is threatening to destabilize the financial stability of the whole country. And this will can spill over to Europe as well, and America as well. America's US is slightly better because the dollar has been very strong and has been really strong against the pound and the euro, and hence the investors and treasuries have lost only the yields, but not in terms of the currency. Um, so with all this in India too, we have had period of low rates. RBI was again suppressing the 10-year yield and all the interest rates in the market, even at a time when the government was borrowing heavily. And when inflation has started to threaten, then clearly the whole they had to stop whatever they're doing, and that's taken up the interest rates very sharply. Looking ahead, or even looking now, the biggest threat to the markets, global markets, is inflation, financial stability, because of the fact that so much of liquidity has been given to markets at very low rates, and all that liquidity has gone into all kinds of asset classes. And governments have taken up huge amounts of debt to bail out economies. Now, at these levels, at higher levels of borrowing costs, the ability to service debt is getting more and more difficult for governments. And they'll have to issue more bonds to actually meet the redemption requirements. And again, they'll have to issue more bonds just to service their debt. Now, this adds to a big concern because again, the whole fact if central banks keep uh, uh, keep worries about inflation, and then they have to come and support the market, then it leaves them in a bind because on one hand inflation is running amok, and on the other hand they'll have to protect the market from destability, financial instability, or whatever, destabilizing financial markets. Now, so both ways, central banks are caught in a bind. We don't know how the whole thing can pan out, and India too is not free from the global markets. To some extent, there is a optimism in India, largely because of the fact that we have been much better in terms of the whole macro economy rather than the globe. But normally the spillover affects all markets, and if the spillovers are very sharp, then India too can get affected. So hence, the interest rates clearly are yet to peak out, and very difficult to say when it can peak out. This year, next year, 3 years down the line. And investors, unless they have a very strong or financial advisors or fund managers, unless they have very strong opinion that interest rates are peaked out, and clearly focus, very difficult to predict, right? Because central banks have clearly got wrong in focus throughout the time. And so hence when the central banks go wrong on focus, the market can easily go wrong on focus. So investors have to be very prudent. There is no rush to invest long at this point of time. The best of investment is to see what is visible and whether they can get returns and they can get their capital back. And that's the only thing that is available to them without trying to focus too much read too much into the future, is the bonds in the 1 to 3 year maturity period. So hence, it's investors are better sticking to advise investments, fixed income products or bonds which is less than 3 years of maturity. And if they can find some good returns on products or bonds, then with stability of with safety and liquidity, then it's the best way to invest in their bonds. So financial advisors, the best place for you to position bonds for your investors, INR Bonds Partner Portal. You come in, log on to partners, check the bonds available. We'll give you curated bonds, give you the full rationale for the curations with our own proprietary risk rating model, which takes into account the whole ecosystem of fixed income environment, and including and also the issuer risk, micro issuer risk as well. So both macro and micro are fed into this model, and it comes out with the risk score. So look for bonds with moderate risk, reasonably good returns, and INR bonds clearly has helped investors ride the whole upward rising yield curve on government bonds and all other, and the sharp fall in value of most products, and low returns offered by traditional fixed deposits by in helping them invest in bonds, earning very steady returns and beating inflation and beating other all products at least by 3 to 4%. So look for these kind of bonds for your investors, and look for our ladder portfolios strategies and other strategies which we can give you. And all you need to do is get INR bonds to help you in your pre-transaction, transaction, and post investment as well. Log into INR bonds and sign up for partner portal. And investors looking for and advisors looking for curated list of bonds and investing in debt IPOs like NHEI InvIT, which is opening on the 17th of October. We can all they need to do is download Quick Invest by INR Bonds app on Google and iOS and Android, and all they need, and just click on the bonds they want to invest in, check the details, and go through the most seamless in-app investment process. Thank you very much for listening in. Do not forget to follow all the podcast channels on Offline Stock Bonds. We have a weekly podcast, and on the YouTube, we have daily bond bites, and on and weekly newsletter search for yields. So if you want to check all INR bonds on YouTube, all you need to do is subscribe to the YouTube channel. Thank you very much.